Welcome to Iron Financial, the only place where we forge stronger portfolios by hammering out the weakness in the market. I'm your lead analyst. Today, we're putting a company under the microscope that presents a classic battleground for investors, Autolus Therapeutics, ticker AUTL. On one hand, you have the story of powerful operational execution. It looks like a fortress being built brick by brick with real revenue and a clear expansion plan. But on the other hand, you've got a stock chart that looks less like a fortress and more like a ruin after a long, hard siege. Our job today is to stress test this entire structure. We really need to figure out if its operational strength can truly support its market valuation, or if this whole thing is just an elaborate financial facade.
And I'm your market skeptic. Let's just cut right to the core conflict here, because this is exactly where investors get trapped. The company is out there telling a story of success. They're pushing out press releases talking about revenue hitting nearly $75 million. They're guiding for well over $120 million next year, and they're showing off a pipeline that promises all this future growth. That's the story they're trying to sell you in their glossy corporate presentation. But the market? Well, the market tells a story with cold, hard cash, and that story is one of profound failure. The stock price is practically scraping the bottom of its 52-week low. Technical analysts are using the most damning terms in their vocabulary, things like dead cat bounce. And quarter after quarter, the company has this really nasty habit of missing its earnings per share estimates. So the question is simple, but it's absolutely critical. Which story is real? The one you read or the one you see in the price action every single day? To get to the truth, we need a blueprint. So here's how we're breaking it all down today. First, we're going to examine the structure under stress. That's the market's harsh, real-time verdict on the stock. Then we'll get our hands dirty and inspect the revenue foundation to see if the bull case is built on solid, load-bearing ground. After that, we'll take out our tools and look for the cracks in the ledger, the financial weaknesses the market is clearly pricing in. Next, we'll review the architectural plans for forging the future pipeline. And finally, we'll put it all together in the forge and deliver the iron verdict. All right, let's get to work. Exactly. Before we even open a single company report or listen to a CEO's conference call, we have to look at the scoreboard. Why? Because the market is a relentless, real-time voting machine, and it's weighing fear and greed every single second of the trading day. And right now, its collective judgment on Autolus is just absolutely brutal. The price chart is the first and, let's be honest, often the most honest piece of evidence we have. It tells us what thousands of investors, from these huge institutions to everyday retail traders, collectively think this company is worth. And believe me, what they're saying isn't pretty. Just look at these vitals. Really look at them. As of the latest close, we're sitting at $1.29. The 52-week low, the absolute floor for the entire year, is $1.11. This stock is trading just 18 cents away from total capitulation. That isn't just a dip. That is a profound, deafening vote of no confidence from the market. A market cap of only $343 million for a company that has a commercial stage life-saving therapy out in the wild? Come on, that signals deep, deep skepticism. The market is essentially screaming from the rooftops that it sees way more risk here than reward, and it's pricing this company for near failure. This is the immense weight pressing down on the entire structure, and it's threatening to crush it. And you know what? It gets worse. When you really dig into the technical analysis, the language being used is just chilling. They're not even talking about a potential bottom or some kind of reversal pattern. No, the term they're throwing around is dead cat bounce. Let's be crystal clear about what that means. It means any small pop in the stock price isn't seen as a sign of life or recovery. It's seen as a purely mechanical twitch on the way to the morgue, a brief gasp before the stock continues its relentless downward trajectory. When this is the label being applied to your company's stock by objective chartists, you are in a structurally compromised position. The market is screaming that the building is unstable, and you'd better get out before it collapses entirely. Okay, the market is emotional. The stock chart is a canvas of fear and greed. It's all noise and sentiment. To find the real strength of any structure, you have to ignore the shaky scaffolding of daily price action, and you have to go down and examine the foundation. And for any company, especially a biotech that has spent years and years in development, the foundation is revenue. Is the company actually selling its product? Is it generating cold, hard cash from its operations? That's where the real story begins. And for Autolus, this is where the bull case starts getting forged in solid steel. Here's the first cornerstone, $74.3 million. In its first full year of launching its lead product, AUCATZYL, that's the number Autolus put on the board. Now, this isn't a projection or some kind of hope. This is a hard, audited number. It proves they can navigate the labyrinth of manufacturing a complex cell therapy, get it approved, deliver it to hospitals, and most importantly, get reimbursed for it. You have to understand, the biotech graveyard is filled with companies that failed at one of those critical steps. So going from 0 to nearly 75 million is a massive feat of execution. This isn't a plan. It's a tangible, solid foundation that has been successfully laid and tested. Okay, now, on top of that cornerstone, look at what they plan to build next. Management isn't guiding for some small incremental increase. They're guiding for 2026 revenue of $120 to $135 million. Let's be conservative here and just use the low end. That's a 60% year-over-year increase in revenue. That is aggressive. That shows a tremendous amount of confidence from the people inside the building who have the most information. They're telling the market, hey, what you saw in 2025 was just us pouring the concrete. Now we are starting to build the skyscraper, and the heavy lifting is already well underway. And this chart right here, this brilliantly illustrates the disconnect. This is the picture the bulls see. Just look at this growth trajectory. From a strong base of over 74 million to a projected 120 million, and that's the minimum. This is the visual representation of the entire bull case. It's a powerful upward ramp, a story of a company hitting its commercial stride, of a product gaining real traction, and of a business that is scaling and scaling rapidly. The market might be focused on the daily price wiggles and the little cracks in the paint, but this chart shows the fundamental engine. The steel frame of the argument is not just running, it's accelerating with force. And, this isn't just wishful thinking fueled by some optimistic projections. This growth is being supported by real-world international execution. They've already proven their commercial model works with strong execution right here in the US market. But as of January 2026, they're expanding. They're launching in the UK after securing a positive evaluation from NICE, which is a major regulatory and reimbursement hurdle. And what makes all of this possible, what underpins the entire global expansion, is a manufacturing success rate over 90%. For these complex, personalized cell therapies, that is the master bolt holding the entire structure together. It means they can reliably make the product, which is the absolute backbone of any sales growth. This isn't a gamble. It's a well-oiled machine that is now expanding its reach. A strong roof and a steel frame are absolutely useless if the foundation you're building on is riddled with cracks. And when I open up the full financial ledger, I see some deep, troubling fissures. The revenue story is great. It really is. It's the shiny exterior, the impressive glass facade they show to the public. But the market isn't just looking at the sales pitch. It's looking at the plumbing, the wiring, the actual profitability and cash flow. And that's where this so-called fortress starts to look a lot more like a house of cards in a hurricane. The market is seeing these profitability issues and it's running for the hills. And the evidence is right here in the numbers. This isn't a one-time issue. This is a pattern of underperformance. In the fourth quarter of 2025, Wall Street analysts, the people who are paid to model these companies, they expected them to lose 27 cents per share. They actually lost 34 cents. That's a big miss. The quarter before that, another 7-cent miss. Go back further, another miss, and another. A company that consistently fails to meet profitability expectations is a company with a serious credibility problem. It tells investors that management either doesn't have a good handle on its costs or is chronically over-optimistic. Either way, it erodes trust. Every single one of these misses is another crack in the foundation. And here is the number that stops the bull case dead in its tracks. A net loss of over $220 million in the last 12 months. Just let that sink in for a second. They probably brought in $74 million in revenue, but they had to shovel 3 times that amount into the furnace just to keep the lights on. How can anyone call a structure strong when it's hemorrhaging cash at this catastrophic rate? This isn't just some small deficit while they scale up. This is a 5-alarm fire in the treasury, a financial black hole. This is the number that keeps the stock price pinned to the floor because the market is absolutely terrified the money is going to run out. So this is the absolute crux of the debate right here. We have to decide what this massive cash burn truly represents. The bulls will tell you, oh, this is a strategic investment. They'll say they're pouring the concrete and buying the steel for a future skyscraper, and that costs a fortune up front. But the bears and the stock chart are suggesting something else entirely. They're suggesting this isn't an investment. It's just the massive, unsustainable cost of propping up a failing structure to keep it from collapsing entirely. Which one is it? That is the multi-hundred-million-dollar question we have to answer. It's a fair question, and the answer lies in the blueprint. I acknowledge the losses. No one builds a skyscraper for free, and anyone who tells you otherwise is selling you something. But you're mistaking capital expenditure for structural failure. That $220 million loss isn't money being burned in an incinerator. It's money being strategically invested. It is the cost of forging a pipeline that has the potential to transform Autolus from a one-product company into a multi-billion-dollar cell therapy platform. To understand the value of the investment, you have to look at the architectural plans for the future. This slide right here, this reveals their master plan. The therapy that's already approved, AUCATZYL, it's based on a technology called BOBCAT. Now look at this pipeline. They aren't starting from scratch for each new disease. They are leveraging their core approved asset. It's already generating revenue for adult ALL. Now they're in phase 2 for pediatric ALL. They're in phase 2 for lupus nephritis, and they're in phase 1 for progressive multiple sclerosis. This isn't just a pipeline, it's a franchise. They are taking one successful cash-generating product and turning it into a multi-front attack on several major diseases. This is intelligent, efficient, and incredibly powerful expansion. And let's put some numbers on the sheer scale of this blueprint. The currently approved market, adult ALL, that's about 1,600 patients in the US. That's what's generating that initial $75 million. Now look at what they're building towards. Pediatric ALL adds another 400 patients. But then look at the next two indications. Lupus nephritis, potentially 35,000 patients. And progressive MS, an enormous patient population of 300,000. The current revenue is a tiny fraction of the total addressable market they are targeting. The spending makes a whole lot more sense when you see the scale of the opportunity. They're not building a single-family home, they're laying the foundation for an entire metropolis.
And this slide directly addresses that cash burn fear. This is the analyst's trump card. The skeptics see the spending and they predict an imminent collapse. But here is the company's own statement, their own structural engineering report. They have enough cash to fund all of this, the current commercial operations and these massive pipeline expansions, all the way into the fourth quarter of 2027. They have the resources, they have the capital to execute this blueprint for the next several years without having to go back to the markets with their hat in hand. The cash burn isn't a sign of weakness. It's a calculated, fully funded investment in future growth. The foundation is poured, and the funding for the next several floors is already secured.
All right, we've inspected the structure from every conceivable angle. We've seen the market's brutal assessment, we've stress-tested the revenue foundation, we've identified the very real cracks in the ledger, and we've carefully reviewed the blueprints for the future. So now, it's time to put all the evidence on the scales, heat it in the forge, and hammer out our final verdict. Is Autolus a deep value opportunity, a future fortress available at a steep discount, or is it a classic value trap, a crumbling facade that's just waiting to collapse on unsuspecting investors? Okay, let's lay it all out one last time. The bull case, my case, is built on a solid foundation of tangible, undeniable results. We have strong, accelerating revenue that's already been booked. We have proven execution in both the commercial rollout and the incredibly complex manufacturing required. We have a clear blueprint for a massive expansion into markets that are hundreds of times larger than the current one. And most importantly, we have a secured cash runway to get the job done. This is the case for a structure that is sound and poised for massive growth. But the bear case, the case the market is currently buying hook, line, and sinker, it points to the visible cracks that are just impossible to ignore. You have an abysmal stock chart that screams weakness and fear. You have a consistent pattern of missing earnings estimates, which completely erodes trust in management. You have staggering net losses that can't just be explained away. And you have the inherent, unavoidable risk that comes with any biotech clinical trial. They can, and often do, fail spectacularly, taking the stock right down with them. This is the case for a structure that is fundamentally unstable and far too risky to own right now.
So here it is, the iron verdict. After weighing all the evidence, Autolus Therapeutics is not a safe, durable fortress. Not yet. The cracks from the consistent EPS misses are real. The financial drain from the losses is significant, and the market's brutal judgment simply cannot be ignored. However, it is also not a failing facade about to collapse. The revenue is real, the execution is real, and the pipeline's potential is undeniably real. Therefore, our verdict is that AUTL is a speculative blueprint. It is a high-risk, high-reward plan for a future structure. The foundation is solid, but the walls are not yet built. The roof is not on, and construction is always a risky business. And that leaves you, the investor, with a final, critical question to ask yourself. Investing in Autolus today is investing in the architect's vision. It's buying the blueprint and the plot of land, and you're betting that the construction crew can execute the plan without a critical failure along the way. The potential reward is immense. I mean, getting in on the ground floor of what could become a skyscraper in the biotech city. But the risk of a construction disaster is also substantial. So you have to ask, do you have the risk tolerance and the long-term vision to invest in a blueprint? Or do you need the security of seeing the finished, occupied fortress before you're willing to buy in?
That is the question you must answer for your own portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.